very strong recovery in just 3-4 sessions. We have recovered about 650 points on Nifty. But I think the big highlight for the day yesterday was that big drop in India VIX, the fear gauge. I mean, the sharpest drop in nearly 5 years. What do you think led to that crash? Is the market not expecting any new hurdles anytime soon, or is it the calm before the storm? I mean, and if that's the case, where do we go from here, up or down?
Hi Suyash, morning. Look, honestly, I think as the name suggests, it's the volatility index, and it is as volatile as anything else, or perhaps more volatile than all other indices put out there, right? So look, I don't read too much into the VIX index. Yes, it just gives you an indicator at times of extreme fear or extreme calmness. That's a good indicator to go, but perhaps in a market which is not throwing up any signals of an extreme fear or extreme calmness, it's not too much to read into, right? However, the index trading quoting at a level of 10, which I can see on your screen right now, is showing a fairly calm market. Honestly, it is showing that there is no volatility expected. It's also showing that perhaps it's when the index is fairly low, it also shows that you can try moving into maybe a little bit of I don't know whether if the index is bottomed out. If we think that the index is bottomed out, then perhaps it's a time to move into low beta stocks. And if the index is kind of peaking up, when you think the index is actually surpassed a very high level, then perhaps you get into low beta stocks. But again, as I said, you don't read much into it. But yeah, in times like the ones when you had the COVID crisis, the index actually shot up a lot because people were fearing the worst possible scenarios out there, right? That it shot up in the global financial crisis time, the US, the CBOE VIX. For India, the also the problem, it's not a very developed index per se. Unlike in US, which is fairly accurate and fairly long-lasting index out there. So my sense is investors should not pay too much attention. However, it also shows us that the market for the time being has kind of settled with all its woes which are going around, and perhaps we can look for few calm days in the market.
All right, a few calm days of for the market ahead. But I mean, Mohit, the big reason for the crash in April was the global headwinds, what was going on in West Asia, and the bond yields, the dollar index, they being on the rise as well. And I mean, we are not hearing much as far as West Asia is concerned, but even though the bond yields, they have been essentially flat pretty much for the last 2-3 days, they are still elevated. We are currently at about 4.6%, and that's bad news for emerging markets. Why are we ignoring those the global headwinds that are coming our way, and could that perhaps be that spoil sport and cap our upside?
Look, I think you're fairly right out there, but from the West Asia perspective, geopolitical perspective, we aren't seeing any escalation per se, or we aren't seeing any escalation in the bad news per se. I think the issue is fairly well settled between Israel and Iran. It looks like though, right? And if that is settled, then I think globally I think markets are fairly calm with that. With regards to the US 10-year yield, we have any which way seen a very sharp spike up, right? From the levels of the lows which saw was 3.9 maybe 3-6 months back, and then it's continuously shooting up and it's gone up to 4.6 because just the expectation of rate cuts is completely out of the window now, and perhaps market is only expecting a 45 bips kind of a rate cut by the year end, which also is questionable. There are two parts to this entire
Calendar
theory.
year
Whether
or financial year end?
calendar year end.
All right. Because,
Right.
from a lot of people, we are hearing that perhaps there will be no rate cut, and maybe Fed could even potentially go for a rate hike, and that's coming from a voting Fed member, the New York president.
Yeah, that's what I said. Look, that 45 bips rate reduction is also looking very unlikely though, and it's getting pushed down, right? When we started the year, the dot plot was signaling 3 rate reductions. It's now signaling 2 rate reductions. It was signaling 50 bips, and now it is signaling 45 bips. So it's been tapering down, and that's the reason the yields have not been easing off, right? But the yields have actually also not tested back the previous highs, which was I think around 4.95 was the level which it touched previously. So we are fairly at that 4.6 level, and I think perhaps market is anticipating that we settle around these levels, and from here on things get better. And that's one of the big reasons why the volatility indices are not showing any kind of trepidation from here on.
Good morning, Mohit. Now, the yields have spiked, as you said, but there's a tech rally in the US which is basically giving rise to a rally in the Asian markets, whether it is Hang Seng, Nikkei, or even the Australian markets. They are in the green today on the back of the US tech rally. Nifty IT in India is just up 0.2%. We have Nvidia, we have Tesla, we have Apple, all looking close, focusedly on India. Why is not India reacting to the US tech rally as much as the other Asian markets? Or do you see that happening in the immediate term to come?
Amit, I think, yeah, I agree to you that the tech rally in India hasn't picked up as yet. Even in US, it's not a very broad-based rally. The big heavyweights which we track very often are the ones which are perhaps doing the heavy lifting out there in US. However, yes, I agree to that point that the Indian tech giants haven't caught up. In fact, the large cap space on the tech side has been woeful for last few times, and to be honest, I have been very hopeful that this perhaps should change sooner than what we expect. But my sense is we still have 6 months to 9 months, at least at the bare minimum, for the tech sector to pick up steam. The at least the heavyweights to pick up steam. My sense is when the market goes through this entire grind and entire cycle, and till such time that the high beta stocks continue to do the rotation in the market, which is when you have the old economy stocks, the PSU stocks, the banking sector all working well. I think tech and FMCG are perhaps a little too late in the cycle, and they will come they will come to the party closer to the level when markets are almost peaking up or are almost trying or almost too tired to then climb further up. So my sense is we are still 6 to 9 months away from a full-fledged tech rally.
It's the earnings season, and a slew of companies will report their earnings today. Among the Nifty 50 firms, Axis Bank, Hindustan Unilever, LTI, Mindtree will come out with their report card. Among broader market names reporting results today will include names like Indian Hotels, Macrotech, Dalmia Bharat, Nippon Life AMC, Oracle Finance, Syngene, among others. But let's talk. And let's start with Axis Bank, because India's fourth largest lender is expected to stage a decent financial performance in the quarter gone by, with growth across segments and double-digit expansion in loans as well as deposits. Axis Bank is expected to report a profit of about 6,250 crore in the March quarter compared to a net loss of 5,728 crore in the year-ago period. The previous year's loss was mainly due to an exceptional charge of about 12,500 crore related to the acquisition of Citibank's consumer business in India. The bank's net interest income, which is the difference between interest earned and interest paid, may rise by about 8.5% year on year to 12,746 crore. Net interest margin, which is a key measure of profitability for financial institutions, may decline by about 11 basis points to 3.9%. And again, as I mentioned, brokerages expect a healthy growth in loans and deposits, both on a year-on-year basis as well as a sequential basis. But coming to the stock, it has been an outperformer compared to the the other large private banks, and Mohit, I'll come to you. It looks at least cheaper, than the large cohort of private banks. I mean, the price to book on HDFC, ICICI, Kotak is between 3 to 3.5. Axis Bank is much lower at just 2.6%. Could Axis Bank be the dark horse in the pack, sir?
Hi Suyash. So look, I think with Axis, it's always been some portion or the other which has been a cause of a little bit of a doubt for the markets, right? Previously, it was the change in leadership when the HDFC leadership was brought in to usher a generational change in the way Axis Bank will operate and how the bank will digitize the entire thing. There was a slew of doubt around that. And then I remember that was a time when Bain Capital picked up a huge chunk in the stock, and people were hoping that it will then usher in a good growth in the stock, but it didn't happen to the extent market was anticipating. And then the Citi acquisition in India, which obviously meant a huge charge on the books last year. And as I hear and as I understand from the street now, the Citi acquisition has been completely, what do you say, taken into account, and I think the banks have also started operationally integrating very well with each other. However, the full scale and extent of it, it's still yet to be known. Look, when huge sizes come together, and that is what we've been seeing with HDFC Bank and HDFC Limited, right? Markets have been fairly uncertain in terms of how the bank will move to the next level of growth. Axis and City merger was not that big a thing as compared to HDFC this thing, but yes, it was still a huge acquisition for Axis as a bank, and culturally the two banks are very different, right? So the integration is an extremely challenging integration, and that's the reason why I think markets has not been giving it the kind of valuations which other private banks have been taking on the street. Having said which, I think the numbers. This quarter are reasonable. I would not say they are like real wow numbers, or they are significantly beating the market estimates or expectations. But yes, it's a reasonable set of numbers, and my sense is stock should work well along with the entire pack, because banking as a pack is looking very attractive. If you ask me, still my top pick will continue to remain as ICICI Bank in this entire space of ICICI, Kotak, Axis, and HDFC. I think that's what market is also liking right now, and that is where all the bets are. And then I think second in the line will be Axis and perhaps Kotak.
Good morning, Mohit. Now, while Axis is in the green and reporting big profits, HUL is likely to announce their results today, and they are mostly flat. Whether it is revenue, a likely jump of only about 0.75%, net profits are likely to go down 2.5% year on year. EBITDA is likely to remain flat at 0.14%, according to market analysts. And this is largely because of higher advertising spends, royalty payouts to the parent Unilever PLC, and the expiration of the GSK deal that will that's likely to impact all the indices. Their businesses, whether it is home care, personal products, beauty and personal care products, home care products, or food and refreshment businesses, they are mostly flat, except for beauty and personal care, which has likely contributed a 2% jump over the year 2024. Input prices cooled off, and the company undertook price cuts to the tune of 2%, which resulted in volume growth of 2 and 3%. But we look at the stock over the last 1 year, it has gone down almost 10%. It is down today. What do you make of HUL? I'm sorry. Is it the FMCG pack that is suffering, or is HUL too big and basically its own weight is basically getting it down?
Amit, I think HUL, the FMCG pack per se is very hugely dependent on the rural economy. It's very hugely dependent on how the monsoons will be, how the rural consumption is picking up, how the rural demand is picking up, how the rural economy per se has been doing, right? And there has been a lot of chatter around that rural economy should pick up around the election season, possibly the impact of which we will see in the next quarter if that at all happens. And I think by all indications, it looks like that post the elections. Uh, from next quarter onwards, given that the monsoon estimate for this year is also fairly good, I think the rural economy should show some signs of improvement. Also, I think we are expecting that private sector capex will pick up, and that should also lead to some rural employment and other things, and which should lead to further augmenting rural growth. Having said which, I think HUL is going through its own set of challenges. The challenge from the unorganized market, the local brands, is more than increasing every day in the Indian context, right? Every day we figure out new brands which are it's like the startup story on the financial side, where fintechs are disrupting the way how financial industry is working, and that story is playing out in the unorganized market in the FMCG side, where the unorganized local brands are trying and killing the bigger brands and bigger names. So the competition is stiffer than ever, and I think that is where the pedigree of HUL, the management, the brand, the long lasting vintage of the firm will perhaps come into play. But market is repricing the stock. Market is repricing from the average valuations of whatever 60 65 or times, the stock is now down to 50 20 times multiples, or maybe a little lesser than that, right? And my sense is there'll be a base which market will come at around. Good quality stocks with good managements, brands which last till perpetuity, will always price very heavily. And my sense is the stock should settle down or should bottom down either by this result season or by next at the worst. And though we don't expect anything extraordinary coming out, but from there on it should become like a good value pick, not value in the sense that the valuations will be cheap, but compared to the historical averages and compared to the peer group, I think HUL will start looking attractive again within a quarter or so. And for patient investors, it's something to look at. For someone who's chasing aggressive growth and in Indian markets, who really want to play the markets very quick and fast, then I think this is not the stock to go for.